To understand Bitcoin, you sometimes have to climb a very deep down the rabbit hole. Conventional wisdom is wrong about Bitcoin. Consensus in the investment community is that cryptocurrency prices will be hurt by an increase in regulation, while the launch of a US ETF could propel prices higher. And while this is likely in the short term, the opposite might be true in the long run. To understand why, consider this. Since it was created in 2008, Bitcoin has inhabited a parallel investment universe that led to wild rallies and crashes, and this caused some who may have wanted exposure to steer clear. While private investors and hedge funds are able to buy crypto, pension funds, money managers and banks largely won't know which boxes to tick on their compliance documents. If, however, a regulatory environment was put in place, that would open the door to a wealth of money chasing explosive returns and diversification benefits. Little wonder then that in the minutes after the Basel Committee on Banking Supervision in June proposed the toughest capital requirements for holdings in crypto assets, Bitcoin rallied. Now consider the flip side. US Securities and Exchange Commission Chair Gary Gensler indicated that he would be more welcoming to an exchange-traded product backed by cash-settled futures rather than by actual Bitcoin. And while this will create a new access point for investors, the long-term implication is negative. Why? Well, because while Bitcoin is an inherently scarce product, cash-settled futures are not. Supply is potentially infinite as long as there are market makers willing to take the opposite side of the trade. Now, it is worth emphasizing that the knee-jerk reaction in both regulation and ETFs will be in line with what the crowd expects them to be. Yet it's also important to consider the ultimate implications, if only so that we don't get carried away in a speculative frenzy. And all of that just proves once again that to really understand Bitcoin, you really have to go very deep down the rabbit hole.